Hello, everybody. Hope you guys are doing great. Today, we're going to be talking about how you're going to be able to maximize an IUL. There's a lot of misconception when you're talking about using this type of policies for infinite banking. If it's something that you want to use for cash value, it's mostly a death benefit type direct type of policy. Well, an index universal life, which is an IUL, you have a saving portion on it, and also you have a death benefit protection sign on it. This policy allows you to also to accumulate cash value as you keep contributing to the policy while you still have your debt benefit on it. Now, this type of policy is going to allow you to be able to loan yourself money out, to be able to acquire money tax-free from the policy when needed. Hello, everybody. Thanks again for coming in and being able to join us up here. Real quick, go ahead and subscribe to the channel. Click the button below, subscribe, hit the little bell. We'll be coming with more content. We'll be coming educating people on life insurance and annuity and financial service side of the house. We're going to be doing a lot of great talks. So I definitely invite you guys to come follow us and be able to connect, comment below, send us a message, and let us know what type of information you guys are looking at. We'll be more than glad to bring people in, go discuss this over, and make sure that you have a great understanding on what it is that you're getting yourself into and where you're putting your money at. Today, we're going to be talking about index universal life max accumulation. So we're going to be talking about how do you max fund these type of policy, why are they good for, and why do you want to max fund them? A lot of times you guys been hearing online or different people talking about this thing called infinite banking. Well, different type of policy can be utilized for that type of strategy. This strategy is not for everybody. Like the same thing, IUL might not be a right fit for you for what you might need to be utilizing this for. So as we go through this video, hopefully this answers some of your questions and make your determination if this is the right product for you. What is an IUL? Well, IUL is an index universal life. Okay, this type of policies are going to be able to have living benefits included into it. In addition to that, you're going to have a death benefit included into this policy, which means you have money that you have funds within the policy that you can use while you're still alive, and also has the portion of it that when you do pass away, and it goes out and pay out to your beneficiary. So how do we structure this? How we have this benefits for us? I got some examples I'm going to be able to show you here in a second. Hopefully this be able to guide you on it. First, I'm going to show you now real quick on how does a regular IUL is funded. Okay, as we go through this, a lot of times these policies are not set up the right way as you might need. If you're going to be talking to your agent about an IUL policy, definitely sit down, make sure you understand what is the index universal life is for, if it's the right fit for you, and how you're going to maximize that policy to your advantage. Okay, one thing you want to understand as we look into the index universal life is that it's a great product when it comes to you able to accumulate cash value and still have that death benefit function with the policy involved with it. The beauty about it, you have the accessibility to the cash when it's available on it, but then you want to have patience to this to grow on you. I'm going to go over surrender charges. I'm going to go over cash value, and I'm going to go over your death benefit. This illustration right here shows what is a 35-year-old male out of the state of Florida contributing $300 a month into an IUL. On this specific strategy that we went ahead and set up for him, as you guys can see, he's putting in the $3,600 a month, a year, correction, on it. And then the surrender value that you see here is what's going to be as cash value. So let me go real quick over so you guys can understand what all these areas of the policy means, okay? The year means the year of the policy. This right here means how many years the policy has been enforced. So when you guys look at this section right here, that's all it's talking about, okay? The age is self-explanatory, the age of the client. The premium is going to be the amount of money the person is putting in per year on this specific illustration. On the cash flow, it's going to be talking how much money they're going to be taking out. In this illustration specifically, there's no money coming out, but you can activate that anytime you want to, as long as there's a cash value available on it. That's a strategy that you want to be sit down to talk about. When do you want to use your cash flow? Well, a lot of times you hear this mostly like a retirement. People use this for as an addition and retirement income for individual. so you can utilize an IUL to actually provide you some funds during your retirement years that will come out of this portion of the cash flow. This is go. Stay tuned so you'll be able to learn more about it in our follow-on videos. Okay. Account value. This is the value that the policy has been accumulating lately during the year. So that's area right there. That was that means on it. Okay. The surrender charge. Very great question. This right here. A lot of times you guys hear, well, I'm putting money into my policy. How come if I got a cash back, I'm putting $3,600? Why I don't have money available? The surrender charge, if you guys notice, depending on your carrier, it can go anywhere between 10 to 15 years on it. That is a charge that the carrier puts in place to make sure that the policy stays into effect for X amount of years. This is a long-term strategy that you're utilizing the index universal life for. So the carrier want to ensure that you're sticking with them for a long period of time. What that being said, there's going to be some fees if you decide to cancel the policy before the surrender period, or if you withdraw any money available from the cash value, it has to be above whatever the surrender value is, okay? But we're going to be able to teach you guys on this specific video how you're going to be able to maximize the fund on it. Surrender value, that's your cash value specifically. What money's available for you on the policy for you to be able to loan out or withdraw whatever you see fit, okay? And the death benefit is the death benefit, what it is, mostly what is available for the client in case they pass away. That's the money is going to be paid out to the beneficiaries. Okay, now, as we see, this specific client is paying $300 a month, which is $3,600 a year on this specific policy. This policy is not structured as a cash accumulation policy. If you guys give the illustration, the first 2 years of the policy, he has zero cash value available for him. Just on year 3, he only has $1,900 available to withdraw out. But guess what? His surrender charge on this specific one, his surrender charge is about $5,300. Okay. What I mean by that is, even though he has a cash value on this specific policy, he cannot withdraw. He cannot make no withdrawals out of it because any withdrawals or any loan, because the surrender charge is greater than the cash value that he has on his policy. So as you continue to put money into the policy, it's going to be able to go through. But I want you guys to see one thing is the account value. Okay. Year 1 is $2,300 account value. He put in $3,600 in. He only has a value of $2,300. He has a surrender charge of $56. So right there, this is telling you right now, this specific policy is going to take some time to accumulate his cash. So as the years goes through, if you guys notice, the account value goes up, keeps going up, surrender charges keeps going down. On this specific carrier, for example, on the year 15 is the final year that he has a surrender charge of $398. But guess what? His account value at that year is $59,000. But how much he has available to loan out or withdraw? $59,000. So at that time frame, that's his final year that he's putting in, the carrier is putting in a penalty fee if he's withdraw or takes a loan out from his own IUL. Okay, like I said, this type of policy are set up for long term. This is not something that you're going to be able to utilize in the next 5 years, 6 years. If you're trying to put your money in there, you want to loan yourself. So if you want to go ahead and start establishing an IUL to be able to have a cash availability, cash value availability, you got to put some time in and you got to put some money in also. Okay, so as we go into this specific example, you guys are going to notice that on year, let's go ahead and just say this person at the age of 55. Okay, at the age of 55, have you guys noticed right here? Okay, he has an account value of $99,000. He has zero surrender charge. And he has a cash value of $99,000. And he has a death benefit $390,000. Okay, which means now, technically, this policy is not costing him nothing because he can go ahead out of the money that he has available. He can, if he wants to cancel this policy out, he's going to pay the taxes if he doesn't withdraw on it. But at least he's going to get his money. He's going to get his $99,000 that he has already available on cash. But now let's go on that note. We're talking about $99,000 at the age of 55. He's been 30, 36. He's been putting that money in for 20 years. Okay, if you guys go ahead and do your math real quick on that one, go ahead and do $20,000. Correction, $3,600 times 20 years. That's equals to $72,000 that this person has contributed into the IUL. Out of the $72,000, he can go ahead and cash out $99,000. So whenever you hear that an IUL is really costing too much money, it's not out there, it's a policy that is it's not good for you, depends what you need it for. Long-term for longevity, this is a great tool out there. It allows you to have that flexibility to utilize some living benefits and also utilize your death benefit, and you're accumulating some cash on these policies. Okay. Remember, these are just illustrations. This is something that is being illustrated during the past 10 years, how the market's been doing on it. Okay, how does the policy accumulate money? We're going to go over that in another video, so stay tuned. I want you guys to understand one thing about life insurance. Life insurance is a contract. The company is giving you a contract saying that they will pay you a specific amount of money when you pass away. That is the death benefit. Okay, out there, that's it. That's what's going to be there. That's the contract you're getting. Some of these policies and products will come with some additional stuff like your cash value, and it's going to have some other living benefits, critical, chronic, terminal illness, child riders. Some of them have long-term care. Some of them have some other stuff out there, lifetime income rider, which means this doesn't matter what's going to happen. You're always going to get paid a percentage amount for the longevity as long as you're alive from the policy. All these other riders are additional costs to the policy. So one thing you want to make sure when you structure your IUL, you want to have this cost effective. Okay, what is the strategy that you want to utilize? Are you looking for death protection with a little bit of cash value, or you want to concentrate on the cash value and not worry too much on the death benefit? Because you're going to have enough money on your other stuff that you're investing with your financial advisors, whoever you're talking to out there, to make sure they balance it out. But this is a foundation when it comes into your finances. Okay, one thing you want to make sure before you do anything else, your foundation on your finances has to be established. And IUL is a great tool to be part of that foundation with additional other products if you see fit. Each person has a different strategy. They got different goals. They got different financial objective. So everything has to be sit down and make sure you ask the right question to your agents to make sure they structure this the correct way for you. Okay. Now, as we can see on this specific event, I'm going to be utilizing the age of 65. Okay, so let's go to the age of 65 real quick on this one, which is mostly when people are already starting to retire. They want to go ahead and start living their life. It's kind of bad to say that you want to wait to 65, but hey, it is what it is. Okay, what do you have an income? So one thing I want you guys to start thinking about, what is your retirement income? What income do you really want to have at retirement age? You have to put inflation into effect into this. What is your monthly expenses most likely going to be? And what is much money a month do you want to be receiving during your retirement years? Okay, all that stuff you got to put it into effect. If you have those questions, you never ask yourself those questions, contact me. We can be able to do a financial analysis to you. We have a great report that we can be able to go through a PDF format for you, break it down. The system will go ahead and populate for you. There are some nice little options that you can do to saving, budgeting, and all that stuff. So definitely give me a call. Send me a text or send me an email. There's going to be a QR code right here. Make sure you go ahead and scan it. Join that channel, contact us, myself or one of my agents. We're more than happy to help you to make sure we be able to find the best fit for you, okay? Now, coming back into what we're talking about. As you guys notice, at the age of 65, okay, on this specific policy, out of $300 a month, he has $221,000 of the value of account value, which means he has $221,000 of cash value on this specific policy. His death benefit is $512. Why is the death benefit keeps going every year? This specific one, I go ahead and set up increasing, which means every year he's going to get more money when it comes to the death benefit, okay? There's different gaps on it, but this specific policy is not set up for cash accumulation. This is just a regular IUL being set up at the best strategy that can fit for the specific goals that the client was needing, okay? On it. So at that note, he has $221,000 that he can be able to loan out to pay himself a retirement income. If he decides to do that, whatever he needs to do, that money is available there to you. If he decides to cancel this policy and walk away with $221,000, he can definitely do that. Of course, there's going to be taxes to that. Now, this specific illustration is a cash accumulation policy. This right here is a policy that is set up because the client needs the money to be accessible in a short period of time. Okay, so he's putting only $300 a month into this policy still. You guys notice $3,600. He's only putting $3,600 into the policy a year into the policy, and that is it. The difference with this one is you're still going to have your surrender charges, but it's a little bit less. The other one's $5,000. Why? Because if you guys notice on the previous illustration, the one right now, he started with a death benefit. He started with a death benefit of $293,000. The client is mostly worried about the death benefit. It's mostly about what's going to be left behind, not too much on cash value. Okay, for that note, he started at $293,000. That's why he has a higher surrender charge. Now, on a cash accumulation, if you guys notice, you want to have a low death benefit. If you notice, the death benefit here is starting at $77,000, which means his surrender value is only $1,400 a month. His account value is $3,000. He's putting in $3,600 a year. Okay, on this one, he has availability of a cash value of $1,600. Okay, he has a accumulation value of $3,000. The surrender charge is $14,000. So available money that he can be loaned out or withdraw is $1,600. Okay, so that's the difference when you're looking at a cash accumulation policy. This allows him to have access to his money at earlier years on it. These numbers, they look beautiful for only $300 a month. But just imagine, and this is at the low end, whoever's really getting into this type of policy, they bring about $500-$600 a month into this policy because they need that money, that cash accessibility to them at a shorter period of time. But it's still, you need to have patience to let this money grow. Okay. Now, let's look on this one. This same scenario, this carrier at the year 15 is when it has this lowest surrender charge value. On this one's $102, but he has $75,000 on it. So by year 16, the accumulation value of this policy is $84,000. The cash value he has on this policy is $84,000. He has a death benefit of $158,000. He's not worried about the death benefit. He's worried about having accessibility to his cash on this specific policy. Okay, so at that note being said, this gives him an early access to some cash if he needs it at an earlier time frame on it. You might do a loans on those. He'd be able to do some loanings out of it. There's loan strategies that you will do on this specific policy. Get with your agent or give me a call, and we'll be able to talk to different strategies out there, what you can do depending on the carriers that you be working with, that we'll be able to find the best fit for you. Okay, so this allows access to that money at an earlier time frame with a lower surrender charge value. Okay, so year one, you still have that cash flow coming to you if you do need to start it. But like I said, you want to have patience on this policy. You don't want to let these things to start growing by themselves. Now, let's look at the age of 65, how this would look. Okay, age of 65, if you guys notice, the client has $274,000 cash value, $348,000 death benefit. Okay, this money, 274 cash value, 274 account value, 3,600. Still, and this specific one, if you guys know that he's not paying no more after the age of 65, that's the way we ended up setting up the strategy for him. He said, "Hey, Francisco, after the age of 65, I don't want to pay no more money into my life insurance policy. I just want to have my money there, and I want to start collecting a percentage out of it that it can still be growing, and it gives me enough cash flow that I need in case I need for my retirement years." Okay, so that's how we set it up specifically for him. But I want you guys to look at it. 30 years that he was contributing into this policy. Okay, so 30 years he contributed times $3,600 a year. That equals he contributed a total of $108,000. Okay, so the client did a total of $108,000 that he has contributed into this policy. At the end of the day, he has $274,000 left of cash value. And if he passes away, he has $348,000 that goes to the family. At the end of what I want to make sure you guys understand is, in time, this policy's value is going to be there. It's going to be more than the money that you put into it. Okay. So your money, you decide later on in 10, 15, 16, after 15, 16 years, you say, you know what, I want to have this policy anymore. Once you close this policy out, that's it. The money that you're taking out of the policy is going to be way more than what you contribute to it. So it's a no-brainer when it comes to long-term having an IUL as a security foundation for it. So as you guys look at it, long-term, this policy works beautiful. Me personally, I love them. I use them myself in different strategies internally that I use for my other stuff that I be doing outside on it. It's a great place that I've been able to acquire cash from my policy to be able to self-fund certain things that I'm doing, and then I pay myself back on it. I don't have to, but I do because I'm still too young in my policy. Once I hit my retirement age, of course, then I'm that time frame. I'm going to utilize this as an income, supplementary income that could come towards me on my retirement age as I see needed. Okay, but I always want to have those funds available there just in case. Just in case something happens, I can always go ahead, get on the carrier, give them a call, and get those monies wire transferred into my bank account as I need it. And I don't got to worry about no tax hits or anything like that because it's a loan on it. Hopefully this explained to you guys real quick how does a cash accumulation policy works. This is a very, very quick video on it. Each scenario, each person is different when it comes to this specific events. You want to make sure that you're able to look what is the strategies that you need, what is your budget, what is your long-term goals, what is your short-term goals, and how this can be able to fit. IUL is a great tool that you can have and that you might want to have in your own foundation. Now, one thing also I want you to see, some carriers allows you to be able to get a policy on your children's, okay? And IUL on the children is very inexpensive. You can definitely start this at a low monthly payment into this, and it's going to grow over the years for that child. Okay, this is a great tool to have for your children to make sure they have some type of foundation established early for them, so when they get to their adulthood, they already have a stronger foundation established, and they be able to move forward into other type of strategies that they can use for their retirement or short-term goals. And definitely look into the Index Universal Life. It is a great product, and different carriers have different strategies within their product with different fundings. Okay, give me a call, send me a text. Feel free to be able to connect with me or one of my agents. We do not work for a specific carrier. Our job is to find you the best carrier that fits your specific strategy and your specific budget. Okay, we're going to be doing a lot of follow-ups doing with you. This is a relationship that we're going to be together. It's not going to be our agents going to be contacting you periodically to make sure things are going well. If there's any adjustment that needs to be done within your policy, if any significant changes in your life that you might have to adjust certain things around. Okay, so once again, want to thank you for your time. Please subscribe to the channel. Give us an opportunity to sit down and give you a financial analysis. I'm looking forward to speaking with you guys, being able to come up with a great strategy for you. Feel free to look at our illustrations that we have with different carriers that we represent. And definitely look into your finances. Set a strong foundation, and let's get ready to establish a strong future. And let's get ready to establish a strong financial future for our children. Okay? Success for the best. I'm looking forward to seeing you guys soon. Have a great one.